Hey everyone, welcome to this explainer. I'm so thrilled you're here today because we're going to tackle a term that trips up so many new investors. But honestly, it's beautifully simple once you look at it the right way. We're going to completely demystify net asset value, or NAV. By the end of our time together, we'll have this concept broken down so clearly that you will literally never forget how it works. Here is our roadmap for today. 1. The meaning of NAV. 2. Inside a mutual fund. 3. Calculating the NAV. 4. The cheap NAV myth. And 5. SIPs and cost averaging. Let's jump right in. Section 1. The meaning of NAV. Decoding the jargon. Okay, so picture this. You walk into a bustling fruit market where prices fluctuate every single day based on demand, season, supply, the whole shebang. If yesterday a mango cost 100 rupees, and today that exact same mango costs 105 rupees, I want you to ask yourself, did the physical mango change, or did just its market price change? The answer, obviously, is that the mango is exactly the same. The only thing that shifted was what people were willing to pay for it on that specific day. Well, mutual funds actually work in a very similar way. Just like that unchanging mango with a fluctuating daily price, when you invest, you're buying units of a mutual fund. The price of one single unit is its net asset value, or NAV. Think of it like one share of a company having a stock price. Well, one unit of a mutual fund has an NAV. So if a fund's NAV today is 50 rupees, each unit costs 50 rupees. If tomorrow it bumps up to 52, your unit is now worth 52 rupees. It really is that straightforward.
Section 2. Inside a mutual fund, the underlying assets.
Imagine thousands of investors all chipping in their money to create this massive financial pool. The mutual fund collects this cash, but it doesn't just let it sit there gathering dust. It buys a highly diverse portfolio of assets. That pooled money might buy Reliance shares, TCS shares, HDFC Bank shares, government bonds, maybe some gold ETFs, and they'll keep a little bit of cash on hand too. All of these investments sitting together in one basket make up the fund's portfolio.
And this is where the daily movement happens, because the market prices of these specific underlying investments, those stocks, that gold, go up and down every single business day on the stock market. The total overall value of the entire mutual fund changes daily as well. When the contents inside the basket gain value, the whole basket is simply worth more.
Section 3. Calculating the NAV, the simple math.
Now, please don't let the math intimidate you. It's really just 3 incredibly logical steps. First, we take the total value of all those assets we just talked about, plus any cash the fund holds. Let's say that totals 10.20 crore rupees. Step 2, we subtract the fund's daily expenses or liabilities. Let's say that's 20 lakh rupees. That leaves us with total net assets of exactly 10 crore. Step 3, we simply divide that net asset number by the total number of units the fund has issued to all its investors. Let's just say there are 50 lakh units outstanding. So bringing it all together, if a fund has net assets of 10 crore and has issued 50 lakh units, that straightforward division, 10 crore divided by 50 lakh, gives us today's exact NAV of 20 rupees per unit. That is the literal price tag for a single unit of the fund on this specific day. And this perfectly illustrates what happens when your investment actually grows. Let's say you invest 20,000 rupees at that 20 rupee NAV. You receive exactly 1,000 units. Now, skip ahead 1 year. The fund's investments did really well, and the NAV increased to 30. Your investment value is now 1,000 units times 30 rupees, which equals 30,000 rupees. Your money grew because the NAV grew. But notice the most important part here. The actual number of units you own, those 1,000 units, never changed. Just like our mango from earlier, the item stayed the same. Its value is what went up.
Moving right along to Section 4, the cheap NAV myth, busting a common illusion. So many beginners fall into a very common trap. They'll look at 2 completely different funds and think, hey, this fund has a 15 rupee NAV, so it's got to be cheaper and better than the fund with a 150 rupee NAV. But guys, this logic is completely backwards, and here is exactly why. Think of a freshly baked pizza. Whether the fund manager cuts that exact same pizza into 4 massive slices, which results in fewer units and a higher NAV, or they choose to slice it up into 8 smaller pieces, resulting in more units and a lower NAV, the underlying size and value of the total pizza remains exactly the same. A lower NAV just means the fund is sliced into smaller pieces. It absolutely does not mean the ingredients are cheaper or better. So the huge takeaway here is to never, ever choose a fund just because the NAV happens to be a low number.
What actually matters is what's inside the pizza. You need to evaluate the quality of the portfolio, the fund manager's expertise, the overall investment strategy and risk level, the historical consistency of returns, and most importantly, whether all of that actually matches your own specific personal financial goals.
Section 5. SIPs and cost averaging. Making volatility work for you. Let's see how this plays out over a few months. If you invest a fixed 5,000 rupees monthly, look at how a dropping market actually becomes your friend. In month 1, the NAV is 50 rupees, so your 5,000 buys you 100 units. But look at month 2. The market drops and the NAV plummets to 25. Suddenly, your exact same 5,000 rupees automatically buys you double the units, 200 units. Then in month 3, the market recovers to 40 and you buy 125 units. This brilliant mechanism is called rupee cost averaging. Because your investment amount is locked in and fixed, when the NAV is low, your SIP naturally scoops up more units on sale. When the NAV is high, it conservatively buys fewer units. It completely removes the stress of trying to perfectly time the market, and it averages out your overall purchase cost over time. Honestly, it's one of the absolute biggest advantages of SIP investing.
Okay, let's do a quick recap of everything we've covered in this explainer today. First off, NAV is simply the daily unit price of a mutual fund. It fluctuates every business day based purely on the shifting value of the underlying assets inside the portfolio. Remember the pizza. A lower NAV is just an illusion of cheapness, not a measure of quality. The absolute best fund out there isn't the one with the lowest price tag. It's the one that perfectly fits your specific risk profile and long-term goals.
I really hope this explainer totally changed how you view mutual fund pricing. Today's insights come straight from the team at Vibuzone, an AMFI-registered MFD and NISM certified expert whose core philosophy is simply your wealth, their expertise. If this helped you out today, definitely check out their work for more practical finance insights that make investing genuinely easy to understand.
Before we officially wrap up, a quick reminder that mutual fund investments are subject to market risks. This explainer is strictly for educational purposes, so please consult your financial advisor and read all scheme-related documents carefully. But honestly, now that you know exactly how NAV works, what is stopping you from looking past the price tag and digging into what your funds really hold? Thanks for hanging out with me today, and I'll see you in the next one.